let us look at provisions under discounting. All right, so when we say discounting, what does it mean? Discounting in provision or discounting under IAS 37 means that at a point, an institution or firm will have an anticipated expenses to make or expenses that is known, but the expenses will happen in the near future. Such expenses should be provisional, or a provision has to be created in the statement of financial position to be expended in the near future. So if should that happen, because the money is not, or the expenditure is not current, it has to be it has to be recognized in the statement of financial position for future expenditure. So for that reason, that money has to be discounted to the present value, because if it is a cash outflow for the future, it's need to be discounted to the present value. Example, if company A has an installed infrastructure on a land, the agreement is that the infrastructure shall be demolished in 3 years' time at a cost of 500,000. All right, so this is a typical example of what discounting provisions. So here, this is the money that will be expended for demolishing this infrastructure in the final year or third year or 3 years time. This money has to be provisional in the system of financial position. However, the expenditure is not current. It will happen in the near future. For that reason, this money has to be discounted to the present value. So how is it done? So we know the discounting formula, which is 1 plus r to the power negative 1 over 1 plus n, 1 plus r to the power n. All right. So with regards to this question, how do you find? So you have your DCF to be 1 plus. So all right. So here they will give you cost of capital. So cost of capital is 10%. All right. So if you want to work out this one, so we will have the R represent the discount rate or cost of capital. So that gives you 0.1 to the power of -3. So I'm representing the number of years. So that is equivalent to 0.751. All right. So there is a discount factor, and then the demolition cost is how much? 500,000. So when you multiply, what do you get? So that gives you 375657. All right. So this is this is the discounted or the present value of 500,000. All right. So once you are done, then when there is cash outflow, or so when there is cash outflow against a company, finance cost is charged against that liability. So the present value of the demolition cost is 37657. Then we need to charge what we call unwound discount, or the unwinding. So the unwinding is the same as what? Finance cost. So with regards to the expected future outflow of money to be paid for the demolition is what? 375,657. Then we charge with the amount of finance cost. So the discounted rate or cost of capital is 10%, and you charge 10% on this one. That gives you 376.5.7. So this is how the discounting is calculated and then provided. So at the end of the day, you can do your journal entry with it, or you can do your extra. So let's start with your journal entry. So you have your debit here. You have your amount discount, which is provision, which is how much? Which is what this simply mean here is that this one goes to what? P&L, profit and loss account. And this one also goes well. It goes to a statement of financial position. Simple. Now you have your journal entry, the provision. You have your debit, and you have your credit. So these provisions are under discount. So you have what? You have your provision expense, which is how much? 37567. Then you have what? Provision that goes into a statement of financial position, which is also 3756. Simply, this is how discounting is what is treated, and this is how it is recognized. So, how about if you should prepare more than one accounting year provisions and one discounting? This example is the situation where it is required for you to prepare only one accounting year. If it's one accounting year, it is simple. After you are done with what? You are done with the discounting. After you have your present value, then what you charge what the finance cost or unwinding what on it, that gives you what the finance cost. Then you take this one to P&L, then you take the other one to system of financial. So I've done the journal entry. Let me also do finance cost. Sorry, let me also do profit or loss extract instead of financial position extract. So and also see that one. So this is the journal entry form. This is a journal entry form. So how about if you had to do profit or loss extract? So you have profit and loss extract. So you have what your the unwinding is how much? Your finance cost is how much? It's 37565.7. Provision. Provision has what? Has double entry. One goes to what P&L on that. One, the other also goes to some financial account. So here you have what your provision. You calculated. One to is how much? 757. Alright, so that is it. Then you can now prepare your statement of financial position. Right. So that too, you have your parent ability, where you will have your online or discounts, which is 37657. Then you will have your non-parent liability. That one too, you have what the provision, which is what 37557. Alright, so preparing the extracts, as you can see now, is the same as the journal entry that we've prepared. Okay, so this is if the requirement is that you should prepare for only one accounting year. Okay, so how is it prepared when the requirement is more than one accounting year? So let us look at this question, then we can solve it together. All right. Appear Money Limited has a concession at the cost of 10,000 and must restore a mine site in 5 years. Estimated cost 2 million. Appropriate discount rate is what? Is 6%. So let us use this example to prepare provisions that expand beyond or that expands or the reporting should be more than one accounting year as we did earlier. Alright, so that is the question here. So the name of the company is with Appeal Limited. The concession on the land was acquired how much? 10 million. Then they said restoration cost is around 2 million. And then cost of capital 6%. Number of years for restoration. That's how many years? 5 years to do the restoration. This is the question. How do you go about it? First, find the discount or find the present value. Alright, so you have what restoration cost to go to 2 million. So you have what 2 million. Let me have 30. So you have 2 million. So that gives you 3,000. Now you'll find the present value. First, find out the discount factor here. Because the restoration is going to happen in 5 years' time. This money cannot sit, or the value of this money will not remain same before the demolition is done. So you need to find the discount or find the present value of this 2,000. So first find the discount. So you have 1 plus the discount rate is 6%. So here will be 0.06 to the power of what? -5. So the discount factor will give you 0.747. Alright. So when you multiply it, 14.94. So this is what? This is the present value of 2 million that will be expended on demolition. 3 or 2, find the total project cost. Now you have the what? Concession 10 million. So just have three zeros. Then you add the demolition cost or restoration cost to it. So that should form part of what the total cost of the project, which is what 1494.5. Okay, so 11, 9, 4, then 3. You find the unwinding. So how do you find the unwinding? Both years is 5 years. You start year 1, year 2, year 3, year 4, year 5. Now, the restoration cost, present value of restoration cost is how much? Is what? 1 for 1494. So then you come and calculate what your unwinding. Unwinding for year 1 is what? 6%. So you calculate 6% of that gives you unwinding. So unwinding here is what? 89.67. So assuming you are to report for you, this would have gone to what? Profit and loss account, and this one too would have gone to statement of financial position. Okay, so both of them will go to profit and loss account, and both of them will go to what? Statement of financial position. Okay, so then you add it when you add it 1584.2. So this becomes your closing balance for year 1. Understand? So if the question requires you to prepare more than one accounting year, then what do you do? Assuming the question is for only one accounting, this one would have been enough. This is what would have been enough. But if I assume like the question is asking you to prepare more than one accounting year, then your closing balance will be the opening balance for year 2. So you have what 1584.2. Then you calculate the unwind discount on the 95. So when you add it to 3, that gives you 1679. Now, if you should prepare more than 2 accounting periods, then your closing balance for year 2 will be the opening balance in year 3. And you calculate what 6% on that. That gives you what 100.8. So do you 1780. So your closing becomes your opening here. So this becomes your online for year 4, 3, 8, to go on and on. You see, 100 to give you 2000. Alright, so that is it. So if the final year your closing balance is not equivalent to the restoration cost, then what you've done is wrong. At the end of the final year, your closing balance should be equivalent to restoration cost. So this is 2 million. So restoration cost how much? 2 million. That is how it is prepared. So that's the table. Then you come and do your P&L extract. You have the profit and loss. So we have year 1, 2. So you start with your online discount or the unwind. So year 1, what is the unwinding? Year 1 is 89.67. Year 2 is 95.1. 100.8 versus 0.8. 113.2. Then you also come and calculate also bring your provision. So yeah, I have the provision. Provision is 1494.4. The 2 is how much? 1584. The 3 is 1679. 17. So this is how the presentation will look with the loss account. Good. Let us look at statement about position expert. How about yes? To your current liability. You have your finance cost or the unwind. So the unwinding year one is what 89.67. Year two is what 9500 106. Now you have what your current liability. Now you have what your provisions. So year one, your provision is what 1494. Year two 1584. Year three 1679. Year four 1980. And year five is what 18869. So this is how the provisions will look like. So in the actual, the final year might have even paid off. So the final year accounting year, we will not have these. I'm talking about these ones. The unbounding year five. Uh, this the asset could have been what could have been the provision could have been what written off on the book at the end of what year five. So this how this thing is what is prepared. However, so when it comes to financial position, some may decide to combine the finance cost and then provision at some point, but it is not, it shouldn't be the best option. So the best option is what you separate it. Otherwise, some can what decide to combine them. When you combine them, then you pick only the closing balances here. You pick the closing balances here as your provision. Okay. So that is how discounting under provision is calculated. Thank you.